August 11th, 2020, 6:03 p.m., New York City. Citibank's servers wire transferred $894 million to external accounts. Not a client instruction, not a strategic decision, not an operation anyone had authorized. It was a three-person review process. Every layer of it failed. The same mistake confirmed 3 consecutive times, and then the money walked out the door. The counterparties on the receiving end, 10 hedge funds, detected the anomaly the following morning. Their internal communications boiled it down to one question. Could this be a mistake? Their conclusion? No. This was money they were owed. They refused to return it. Citibank sued. The district court ruled. The funds win. The entire financial press went into shock. The Second Circuit Court of Appeals reversed. Citibank wins. But the story doesn't end there, because while this case was suspended on appeal, Revlon filed for bankruptcy, and that $900 million, a wire transfer that was supposed to be nothing more than a routine interest payment, became the entire American financial system's reckoning with one fundamental question. When money lands in your account to the penny, can you really pretend you didn't know it was wrong? Let's begin the autopsy from the top. Rewind to 2016. Revlon, America's cosmetics empire, queen of lipstick, parent company of Elizabeth Arden, needed money. A lot of money. It borrowed $1.8 billion from a syndicated lending consortium, a 7-year term loan due September 7th, 2023. Citibank served as the administrative agent, essentially the accountant and messenger between Revlon and several hundred creditors. 4 years passed. By 2020, COVID had nearly finished Revlon off. Q1 net loss, $213.9 million. Adjusted EBITDA year over year, down 26.8%. Its debt was being offloaded on the secondary market at 20 to 30 cents on the dollar. For every dollar of debt, the market said it was worth 30 cents. This company, in the words its own creditors would later use in court filings, was insolvent by as much as $1.71 billion. That is the entity at the center of this story. And on the afternoon of August 11th, 2020, just after 6 p.m., its bank, Citibank, suddenly wire transferred nearly $900 million to its entire creditor syndicate. Repayment of principal. Principal that wasn't due for 3 more years. To the cent. Not a single dollar off. Now we enter the operating room and examine how this erroneous transfer passed through every layer of a system specifically designed to prevent exactly this. The instrument, Flexcube. Flexcube was Citibank's internal platform for executing wire transfers. It had one critical function. When processing an internal accounting operation, moving funds into a wash account, an internal ledger entry that kept money inside the bank, you had to manually check 3 fields in the system: front, fund, and principal, all directed to the wash account. All 3. No exceptions. The procedure manual stated it in plain text. All 3 fields. But Citibank's asset-based transitional finance team, the ABTF team, didn't know this. More precisely, they knew the rule, but they had misunderstood it. They believed that checking only the principal field was sufficient. This misunderstanding existed simultaneously in three separate people. The first, Ravi, the maker. Between 5:15 and 5:45 p.m., he built out the transaction in Flexcube, checking only the principal field. Front and fund, unchecked. The second, Raj, the checker, Ravi's supervisor. He reviewed Ravi's work, found no issues, approved it for release, and emailed the final approver. Note: principal set to wash and interest notice released to investors. The third, Frada, Citibank's senior manager based in Delaware, the final approver. He replied to Raj, "Looks good. Please proceed. Principal is going to wash." Three people, three checkpoints. Every single one of them believed the money would stay internal. Then Raj clicked Final Confirmation. The system generated a warning dialog, internally called a stop sign, that read, "Account used is wire account, and funds will be sent out of the bank. Do you want to continue?" Notice what this warning said. Notice even more carefully what it didn't say. It did not tell you how much money was about to go out. It did not distinguish between interest and principal. Between $7.8 million and $894 million. Raj knew the interest payment needed to go to the creditors, so facing this warning, he clicked Yes. At 6:03 p.m., the wires went out. What follows is the most absurd passage in this entire story. At 6:53 p.m., Ravi finished organizing the transaction documentation and forwarded Flexcube screenshots to Raj. Those screenshots clearly showed, under the amount paid field, $7.8 million in interest and $894 million in principal. Ravi saw that number. He did not think anything was wrong, because he believed, incorrectly, that the $894 million line represented principal that had been safely routed to Citibank's internal wash account. He sent the email. He went home. The next morning at 9 a.m., Raj began his routine reconciliation. He needed to verify that all inflows and outflows from the previous day matched. He found massive discrepancies. At 9:37 a.m., he emailed Frada. Principal was set to wash and only interest was set to DDA. But it looks like funds have gone out. Can you please review? Frada's first instinct. Maybe a system bug. At 9:52 a.m., Frada messaged his supervisor, Vincent Farrell, head of Citibank's North American loan operations, on Skype. His exact words: "Bad news. Principal to wash. Wires look like they went out the door." Minutes later, a follow-up. "Yep, confirmed. Principal out the door when it was supposed to be sent to wash for Revlon restructure." By midday, Frada had the full picture. This was not a system malfunction. This was human error. Three people, all of them operating under the same false understanding of the same procedural control. Not one person in the entire process had noticed that the wash account balance never moved. At 2:25 p.m., Citibank began transmitting recall notices to the full creditor syndicate. Total wired out, $894 million. Amount needed back, $894 million. We need to pause here and account for where those $900 million actually went. Revlon's $1.8 billion syndicated loan involved 315 individual creditors. That afternoon, Citibank had dispersed funds to all 315 accounts on a pro rata basis. The overwhelming majority of fund managers, upon receiving recall notices, returned the money. Approximately $385 million came back. But 10 funds refused to return theirs. Their combined position, $558,558,375.74. The 10. Brigade Capital Management, HPS Investment Partners, Symphony Asset Management, Barden Hill Loan Management, Grey Wolf Loan Management, ZAIS Group, Allstate Investment Management, Medalist Partners Corporate Finance, Tall Tree Investment Management, and New Generation Advisors. Their logic: this money is owed to us. Revlon's debt to our clients, principal plus accrued interest, has been paid down to the cent. Citibank's internal operational failure is Citibank's problem, not ours. That logic had a legal foundation. In 1991, the New York Court of Appeals established a doctrine in Bank Worms versus Bank America International known as the Discharge-for-Value rule. The core logic: if a creditor receives a payment equal to the amount it is legitimately owed and had no notice that the transfer was made in error, it is legally entitled to keep the funds. The rationale? Wire transfer finality and certainty. Recipients cannot be forced to live indefinitely under the uncertainty that money received today might be clawed back tomorrow. The Bank Worms case itself was straightforward. A bank, acting on client instructions, wired a payment to a creditor whose loan was legitimately due. The client reversed course mid-execution, but the bank had already sent the wire. The creditor had no notice of the reversal. The court ruled in favor of the creditor. These 10 funds cited exactly that doctrine. District Court Judge Jesse Furman, in his February 2021 ruling following a December 2020 bench trial, upheld the defense. His reasoning: Citibank was one of the most sophisticated financial institutions in the world. An error of this magnitude was, by that standard, unprecedented and essentially inconceivable. And the fact that each fund received an amount corresponding to the penny to its outstanding principal plus accrued interest was, by commercial common sense, sufficient for any rational investor to conclude this was a genuine repayment. Ruling: the funds were entitled to keep the money. Citibank was blindsided. But Citibank appealed. On September 8, 2022, the United States Court of Appeals for the Second Circuit, a 3-judge panel of Laval, Sack, and Park, reversed the district court. The appellate ruling operated on 2 independent layers of analysis. Layer 1: these funds were on notice of the mistake. What does notice mean here? In New York law, the applicable standard is called inquiry notice. If the facts available to a recipient are sufficiently anomalous that a reasonably prudent investor, one facing a risk of loss, would have made further inquiry, then the law treats that recipient as having constructive knowledge of whatever that inquiry would have revealed. The test is objective. It is not about what the recipient actually believed. The Second Circuit found that on August 11, 2020, any reasonably prudent professional investor confronting this wire transfer should have had questions. Why? 4 red flags. Red flag 1. The loan agreement required advance notification. None was given. Under Section 2.11a of the 2016 loan agreement, any voluntary prepayment by Revlon required irrevocable written notice to Citibank at least 3 business days in advance. Upon receipt, Citibank was contractually obligated to promptly notify each affected lender. That notification sequence never happened. The money arrived with no preceding communication of any kind. It simply appeared. Red flag 2. Revlon was believed to be insolvent by $1.71 billion. Where did $900 million in cash come from? These funds were themselves the plaintiffs in Revlon's debt crisis. They had authorized UMB Bank to sue both Revlon and Citibank. That 117-page complaint had been drafted and ready to file. It was formally submitted on August 12th, the day after the wire transfers. Inside that complaint, in plain language, Revlon is insolvent by $1.71 billion. These funds knew better than anyone that Revlon did not have $900 million in cash. Red flag 3. The debt was trading at 20 to 30 cents on the dollar. Why would Revlon repay at full face value? If Revlon genuinely wanted to retire this debt early, the rational approach was to buy it back in the secondary market at a substantial discount, acquiring $1 of debt for 30 cents, not paying out $900 million at par. A deeply insolvent company voluntarily repaying unmatured debt at 100 cents on the dollar violates basic commercial logic. There was no evidence of any such secondary market buying pressure. Red flag 4. A transaction executed 4 days earlier made voluntary prepayment self-contradicting. 4 days before the wire transfers, on August 7, 2020, Revlon had launched an exchange offer on its 2021 notes. The sole documented purpose of that transaction was to prevent the 2016 term loan from triggering its springing maturity provision. If Revlon was planning to voluntarily retire the 2016 term loan in full 4 days later, it had absolutely no reason to spend those 4 days engineering an elaborate maneuver to prevent that same loan from being accelerated. 4 red flags. Any single one of them, standing alone, should have been enough to prompt a reasonably prudent institutional investor to pick up the phone and call Citibank, to ask, "What is going on here?" Not one fund made that call. The Second Circuit's analysis continued to the second layer. Layer 2. Were these funds actually entitled to this money? The Discharge-for-Value rule has a prerequisite beyond creditor status. The recipient must have been entitled to the payment at the time it was received. The debt must have been due and payable. The 2016 term loan's contractual maturity was September 7, 2023. As of August 11, 2020, that date was 3 full years away. No acceleration provision had been triggered. No event of default had been declared. The creditors had no present enforceable right to demand principal repayment on August 11, 2020. The Second Circuit's holding. Because the defendants were not entitled to the funds at the time of transfer, the Discharge-for-Value shield does not apply. The doctrine's predicate condition was never met. 2 independent grounds. Either one was individually sufficient. Together, they were decisive. The district court's judgment, vacated. The case, remanded. Citibank's right to restitution, reinstated. There is an epilogue that elevates the irony of this entire sequence to another register entirely. On June 15, 2022, while the Second Circuit was actively deliberating this appeal, Revlon filed for Chapter 11 bankruptcy protection. Think carefully about what that means. In August 2020, these funds held on to that $900 million on the grounds that it represented legitimate debt repayment, that these funds constituted money Revlon genuinely owed them. 2 years later, even if Citibank had never made this mistake, even if the loan had run to its natural 2023 maturity, how much would they have recovered from a Revlon already in bankruptcy? In the priority waterfall of a bankruptcy liquidation, their recovery rate would almost certainly be well below face value. They had purchased this debt in the secondary market at 20 to 30 cents on the dollar. So in reality, the those $900 million represented an unexpected windfall of full par recovery. Had they returned the money as demanded, they would likely have ended up recovering a fraction of par from Revlon's bankruptcy estate. They knew Revlon was insolvent. They had filed the complaint saying so. They knew the secondary market was pricing the debt at a fraction of face value. They understood what a Chapter 11 filing would do to their recovery position. They knew. Of course they knew. The final page of a forensic report is always cause of death. The cause of death in this case is not a checkbox that went unchecked, not a procedure manual that was misread, not a warning dialogue without a dollar figure. The cause of death is this: a legally valid financial architecture that permitted rational, sophisticated institutional investors, upon receiving a clearly anomalous 9-figure transfer, to elect to play the role of innocent bystander. Ravi, Raj, and Frada committed an operational error. The 10 funds played a rules game. And a rules game is far harder to prosecute than an operational error, because every move sits just inside the legal boundary. Right up until the moment a court redefines what "you should have known" actually means. The lasting question this case puts into the record is not that Citibank won, or that the funds lost. It is this: the next time $900 million appears in your account without explanation, you have a question you need to ask yourself. Is this money actually mine to take? Or are you simply deciding not to ask that question?